Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hello and welcome to the podcast. I'm Brendan Campbell. Today is the 18th of September 2024. It's been a long time between podcasts, longer than it needs to be. So we thought we'd better get on and get another one happening. And in particular, we thought we'll talk a bit about FBT. So there's a few upcoming events that are probably getting planned in offices at the moment, Melbourne Cup, Christmas parties, whatever it is. So this is the time to get a regular back on. Charles Yuan, one of our associate directors here at Prosperity, all things tax, indirect taxes, FBT, absolutely loves it. So we're going to chat to Charles and he's going to impart some wisdom on us. Charles, thanks for joining us.
Always good to join this podcast and impart my wisdom. Tax is exciting and really, it's obviously a major part of most businesses. It's probably one of the second or third biggest cost of a business. Yep. So it's important to ensure you get it right and find all the exemptions you are eligible for.
That's right, and we'll try to keep it as interesting as we can when two accountants start talking about fringe benefits tax. It can get dry, but hopefully Charles and I can keep this somewhat palatable for the listeners out there. So Charles, a couple of things I guess we're going to talk about parties. So whether it be, as I said at the start, I guess, whether it be Melbourne Cup, Christmas parties, talk about gifts and maybe importance of separating out gifts from the event itself or even other gifts that we might be giving. And then we might touch on a bit of cars as well. And you and I, favourite topic, EVs and FEVs. We'll do an update on that because there's a couple of key dates to get right, particularly for FEVs, I guess, going forward.
That's right.
Cars available on the market as well. So let's kick us off. Let's talk about parties, Charles. We're having a FBT. We're having a Melbourne Cup party. What do I need to worry about? Can we just lay it on and claim it all as a tax deduction? Surely you're telling me that's how it works.
Well, unfortunately, no. As with all things tax, what you hear down the pub may not be reality. Everyone knows that, Christmas party, that should be exempt. It's un-Australian to tax Christmas parties.
Absolutely.
And also Melbourne Cup, for that matter. Christmas parties can be exempt from FBT, right? There is hoops you sort of have to jump through, but then there's also income tax implications for exempting from FBT. So, at a high level, how that works is there's a thing called minor and infrequent exemption. And that's where the tax office says, look, if you provide any sort of benefit and it's less than $300 per employee, and it's also provided infrequently or irregularly, or in some ways that it's, say, once a year, or it's something that's not expected to reoccur,
or even a couple of times a year, I guess, because they define.
Yeah, I mean, exactly. It's not a hard rule. It's not like one is frequent or one's not infrequent, two's frequent. There's no hard and fast rule, but it just comes down to in the context of the entertainment that's been provided, would it be unreasonable to treat it as a fringe benefit?
Yeah.
So that's sort of the exemption. How do you get it? It's actually a little bit of paperwork that you need to do as a business owner to ensure that you actually get that benefit. First thing you need to do is ensure that your business uses the actual cost method. And what that involves is a little bit of record keeping on your side to ensure that you have record of how many people attended that particular event, how much did you spend, where was it held at, general stuff like that.
That helps obviously getting that minor part of it, the under 300, because if you can work out that 30 people attended and the cost was whatever it is, and was that under $300 a head? And I guess the interesting thing that we like to look at sometimes as well, it's not just 300, it's not just per employee if they bring a partner, as long as the total cost per head is under 300. That's my understanding.
That's right. It's in fact $300 per person that attended the particular event. So if it's a employee plus partner, then it's really $600 per employee because you get $300 each person. It's not only limited to employees themselves. So that's a great way to ask your employees to bring their partner along and have a more lively event than just a bunch of accountants sitting in a room, right?
That's right. And you mentioned the actual cost, and I guess without going down a whole rabbit hole of difference between the actual and 50/50, we might just touch on that. But if we're using the actual cost, it's important to probably remember as well, while this is exempt from FBT, because it's an entertainment as such, if it's exempt from FBT, that's great, but it still means it's not deductible, which is a better result than being deductible and subject to FBT, which is the other way. Because obviously that FBT is at the full tax rate, and that'd be on the basis that the only way that's even on par with this is if every employee was on more than 200,000 a year kind of thing, which is unlikely in most businesses. So it's normally better to, if you can, to under the actual method to have that minor and frequent benefit where yes, it isn't subject to, it's not subject to FBT, but it's not deductible, but that's still a better result than having a tax deduction and paying FBT on it.
That's right. Yeah, that's absolutely right.
Just talk through that that actual cost versus 50/50, because that's sort of an election and it's just in relation really to the entertainment part of FBT.
That's right. It's in relation to entertainment, and it's not just meals, but it could be a recreational events such as a team bowling event or stuff like that. What a lot of businesses would do, and it's sort of a administrative concession, is you can also use what's called the 50/50 split method. So you take all of your entertainment that you've incurred in your business, split it right down the middle. Half of it is subject to FBT and half of it is not. And why would you do that? The primary reason you would do that is to save yourself the administrative cost of having to compile documents. But the biggest drawback of using the 50/50 method is if you choose the 50/50, you can't use the actual cost method. And if you can't use the actual cost method, you can't use the minor and frequent exemption.
Yeah, so suddenly per event.
That's right. So so you think you're saving yourself administrative burden from not having to keep records, but you're also making your Christmas parties subject to FBT, or at least half of it.
And essentially, in that case, it's really, well, half of it is subject to FBT and half of it is deductible, and half of it is not subject to FBT and not deductible. So, if as per the previous example, if you've got staff who are on less than $200,000 a year, then you're probably, if you can, better off using that actual method if the parties they're attending are infrequent, once, maybe twice a year, and less than $300 a head. Keep a few records, get it that way might be the better way to do it.
Yeah. And look, in this day and age, everyone has electronic bookkeeping systems. It's not hard to just type a couple extra words against each line. You don't, by record keeping, it doesn't necessarily mean you need to keep a copy of your receipt from the restaurant that you go to or the cafe. It's literally, just proving that each expenditure line, what did you spend it on? And your bookkeeper can just exactly. You have a Christmas party. When you code the expense in your ledger, just adding a few extra words. 20 employees at this Christmas party, or 20 employees plus 10 spouses,
just to track it. Yeah, that's right. So that's Melbourne Cup coming up, Christmas parties, etc. Whatever else happens throughout the year.
Yeah.
What about gifts? If I'm giving staff a gift, I'm leading you in deliberately to this one. I don't know it's coming, Charles, but what about a gift? If I give a staff member a gift, how does that work in an FBT world? And what are some of the traps and some of the good things out there?
Gifts. So gifts is obviously an important part of rewarding employees. And as long as gifts are not entertainment, it's actually not subject to the same entertainment tax rules, right?
Absolutely.
So again, now gifts could also be subject to fringe benefits tax, but because it's not entertainment, it doesn't need to go into that same bucket with the other entertainment expenses. You get the same $300 minor infrequent exemption. So if you give your employees, say, a $200 gift card as part of your award at the Christmas party,
The
as long as
recognition, blah, blah, blah. Yep.
yeah, as long as you separate that out of the total expenditure pool of the Christmas party, you can treat that gift card as exempt, and it can be $200 gift card for every employee. Your cost a couple of $1,000, but it's exempt because it's less than $300 per employee.
And yeah, and I guess $290 gift card I'd go to as well, potentially, if it's under 300.
$299.99 to be precise.
And the benefit of that is it's different to entertainment, because if it's minor and infrequent, so not regular, it's under $300, $299, as you said. It's minor, it's infrequent, therefore it's not subject to FBT. But because it's not entertainment, it's still tax deductible. So
Correct.
huge, well, not huge, we're talking $300, but it's tax deductible, no FBT. Brilliant. It's a win-win. And it's a great way to reward staff. And if we're doing that, rewarding staff, well, isn't it great that we get a tax deduction? No one's paying tax on it. I'll take that as a win as well. Obviously, that's not the reason we're doing it. We're doing it to reward staff. But if we can do it within the parameters, it makes life a lot easier for everyone and a bit more palatable. And maybe you can push it up from a $200 to a $250 gift card if that's the case, if you know that you're not actually paying tax on it. So
and realistically, what this means is, your Christmas party, you don't have to hold a $600 per head Christmas party. You hold a $300 per head Christmas party and a $300 gift card. I mean, $299. So, but yeah, you get the gist. It's a great way of, as long as you have the records to clearly separate the expenditures, then it just makes sense to do it that way.
And you mentioned as long as it's not entertainment. What's your? I love your example you give, Charles. If I give a bottle of whiskey, is that entertainment?
That's a funny one. There was a tax office case officer who made a comment on how the rules will apply. If you gave a bottle of whiskey, or wine, and it's opened at the party, it's entertainment,
and therefore not.
But if you don't open it and give an unopened bottle of alcohol,
it doesn't get opened.
It's a gift. It's a property benefit, and therefore it's not entertainment, and you can fully deduct it. How strange is that?
If they take the bottle of whiskey home, it's not entertainment. But if they drink it, if you give it to them and they pop it and have a swig, it's entertainment.
Yeah. So when you give bottles of champagnes or whiskeys to your employees, make sure they don't open it.
If someone drinks a bottle of whiskey at your Christmas party, that probably is entertainment, but probably not the right one. So maybe we won't go down that one. We'll leave that one alone. But yeah, a few nuances there, so it's important to understand it.
There's actually also one other gift type exemption, the long service award.
Oh yeah, of course.
Yeah, not many people actually know this. And this is strange in the name, long service awards. But if you have any employees where they have over 15 years of service to your
15,
business,
not 15, yeah.
15, you get an exemption up to $1,000 to give them a gift of any sort, whether that's a gift card or a paid holiday, a bottle of very expensive wine.
Or a very good whiskey, a nice Japanese whiskey, Yamazaki 12 maybe, something nice there.
Yeah, or 3 bottles of it under for the $1,000. But that's actually exempt. So in addition to the $300, you can use this exemption for any of your long-serving employees. And with a lot of small businesses out there, you probably would have 1 or 2 employees who stuck around your business for a long time.
Yeah,
you can utilize this.
If you're rewarding that staff member, which is fantastic. But if they're over 15 years, the $300 doesn't apply. You can push it out to $1,000, or even more so of every year over 15. It goes
every year above 15, you get an additional $100. So for 20 years of service, you can give them a $1,500 award. fully
Yeah.
exempt from FBT and deductible.
So something that might apply to a few businesses out there for a long-standing staff member. You want to give them something a little bit extra, absolutely worth considering.
Yeah.
Moving to our favourite topic, FBT vehicles. I know you and I spruik a fair bit of the old EVs and the FEVs out there, just because of the concessions that are so generous at the moment. Be worthwhile. We might just touch on those, and we might even just touch on other vehicles, whether that's worthwhile. So even if it's not an EV or a FEV, it still can be beneficial to salary sacrifice a vehicle and offer that as a retention thing for staff to keep them happy in this world where that's really important, is keeping your staff happy. Offering that, that remuneration, that salary packaging option, I guess, for staff, where they can package a vehicle, whether it be an EV, BEV, or internal combustion, whichever it is. So EVs, I'm right in saying I think it's 91,000. We're writing it down earlier, 91,387. As long as it's under that number, and that's the luxury car tax for fuel efficient vehicles. If you purchase that, it's provided. There's a few nuances to get right, but it's purchased by the business, provided to an employee, then there is no FBT to pay on that. A small thing to just consider is, and it's a very minor thing, but the tax deduction for the actual depreciation of the vehicle is still capped at the $69,674, but it means that there's no FBT applies. So look, the deduction is slightly less for the lease cost if it's above 70 grand, if it's between the 70 and 90, but it's still an excellent thing to have. And then also any rego insurance and all those sort of costs, they're all fully tax deductible pre-tax as well. So really great thing to have in there. And FEVs still, so FEV plug-in electric hybrid vehicles. So that's one you physically plug into a wall. That is also captured under those same rules, but only until the end of March 2025, which is 6 months away.
Yeah, not that long away.
It's getting closer, and there's a little caveat. You just want to make sure if you haven't got advice on it, and you sort of maybe just heard us talking about it on our podcast, just a little thing to be aware of is that FBT will apply in the future years for any new contracts that are entered into. So I guess the tip in that, Charles, is make sure you've got in place, I don't know, 5-year lease or something, or some sort of salary package arrangement that's signed, that's in writing, that's in place before the end of March 2025, because if you renegotiate that contract in July, then it would be subject to FBT if it's a FEV. So I guess for those employees who've got FEVs, which is still a great way to do it, just make sure you've got longer term contracts in place and agreements in place, I guess is the rule. It's kind of new legislation out there, and whether that's an official salary package in place, or if you're the owner of the business, maybe it's a written contract confirming that, that be provided to you for whatever period, etc. But just to work that out, to make sure there's something in writing in place is a probably key takeaway I've talked about.
Exactly. Ensure the key is ensure you have a written agreement to provide the car benefit to your employee, and that agreement is in place before 31 March 2025, the end of the next FBT year. So as long as it's in place, that exemption on that vehicle can run beyond the expiry of the exemption for plug-in hybrids. But unfortunately, if it's, even if you acquire the vehicle before that date, but into the agreement after that date, you're not going to get the exemption. So it's important. If you have one in place now, consider renegotiating the contract before March next year. If you haven't got one, make sure you get one and into an agreement before that date. Obviously, full electric hybrids, the battery only ones will continue for the foreseeable future, but it's specifically those plug-in hybrids, which I guess a lot of people out in the regions will probably prefer that option. Charging infrastructure may not be that great out in the regions.
That's right. But with all of this, devil's in the detail. Talk to your advisors, talk to us, get that done right. You don't want to just risk that. And I guess if you need salary packaging too, with Prosperity, obviously we have a salary packaging team who can put all those officially in place for you if you want to do it that way as well. So we work a bit, got a salary pack team who can do all that, put it together.
Yeah.
What if it's not an EV and not a FEV, Charles?
So speaking of salary packaging, if it's not a electric vehicle or plug-in hybrid that's subject to the FBT exemption, well, normal car fringe benefits tax would apply. But the thing to keep in mind, and I guess what a lot of people don't realize is it's still extremely beneficial from a tax point of view to salary package a vehicle. Now, it may be arguable whether the value's there for buying a new car and having to take out a loan at current interest rates. But if you're going to um, take out a lease or a loan on a vehicle anyway, it's actually significant tax benefit to salary package it. Now, with car fringe
Absolutely.
benefits,
Even if you weren't going to take out a lease, the other option was you're pulling money out of your offset. Well,
mm,
effectively, you are taking out a loan right to do it. So I'd rather leave
yep,
the money in the offset and do it through some sort of lease arrangement where at least the interest on this is tax deductible.
exactly. And the benefit of that, it's you're taking it out of your pre-tax salary, so you're reducing your withholding tax, and especially for high income earners, people over the $100,000 mark, where you're at the highest or the second highest tax brackets, you're getting a massive tax deduction essentially, and that deduction doesn't have to wait until you lodge your tax return. You're getting straight out of your pay each period.
And
So
I would stress, obviously, as you said, if you're earning over $100,000 a year, it's probably worth it. I will stress that it's not worth it for every vehicle. If it's a $300,000 vehicle, it's maybe not worth it because your depreciation is still
yeah,
up to that 69,000. So if it's over 100 grand, maybe think about it. But if it's over 100, sorry, it probably isn't going to work on that method unless you've got a really, really high logbook percentage, and then it could still work. But it comes down to a lot of factors. Are you the type of person going to turn this car over in 2 to 3 years and get another one? Well, then it may not work because if you're all of a sudden you're buying it at 100,000, we're claiming depreciation and GST, and that's all capped to the 70,000 mark, and you sell it for 80 grand later. Well, we've got to include the full sale price as income. Deduction of 70. It's not. Yeah, there's a lot of factors, but I guess rule of thumb is if you're earning more than 100 grand a year and you're salary sacrificing a vehicle that's say 70 grand or thereabouts or under, it's sort of a really good way to do it if you can salary package it through your work, or as I said, reach out to our team, etc. We can help with that. But even if your employer offers it, go to the employer, look at the options with them, talk to your accountant, talk to Prosperity, let us guide you through that. But yeah, we're going around the edges of the benefits, but if you can save 4 or 5 grand a year, I'm all for saving 4 or 5 grand a year.
Absolutely. Yeah, and I guess that's our job to make sure our clients pay the least amount of tax that's legally possible, right? And
without avoiding it.
It's not tax avoidance. It's a benefit that's been around for a long time. A lot of big organizations provide that service.
Absolutely.
And if if you work at a smaller organization and they're not sure about offering that type of service, well, it's not difficult. Speak to our salary package division. We provide all-inclusive service from head to toe, and all your employee need to do is just sign on a piece of paper to agree to the agreement. So
we've turned an FBT update into it. Sounds like a pitch for the salary packaging, but unintentional. But absolutely, our team can help with that. Absolutely.
Exactly, and FBT benefit. It's all about taking the FBT benefits. There's no cost to the employer, and you save yourself tax.
Absolutely.
Why not? Why not?
Absolutely. Yeah, why not? Exactly. Charles, we might end it there. That's, I think, a really good update. FBT, so Christmas parties, gifts, gifts for staff who've been around a long time, 15 years or more, cars, EVs, FEVs, other vehicles, lots of benefits, lots of things to get. FBT is something just important to consider. I don't think many small businesses consider it as much as they should, but it's important to keep an eye on it and know what's happening with it. So Charles Yuan, thank you very much for that update. I think we've kept it lively enough, it's impressive for 2 accountants talking about tax. So hopefully everyone out there enjoyed that, and the podcast will be back to being a bit more regular after a small hiatus. We're back on track. Charles, if they want to reach out to you, it's CUAN at prosperity.com.au. or just jump on the website and find us. Anyone else, jump on prosperity.com.au, follow some links from there, find previous podcasts, find out what we do, and ring us and have a chat. Talk to you all soon. Charles, thanks for joining us.
Yep. Thank you.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.